Hello, everyone, and welcome to the Buck Stops Here. I'm Catherine Murray. Well, as we look at the markets, it's certainly been a very interesting year, a very volatile year, a lot of unknowns, and we're heading into the year end. And just to put everything into perspective right now, we've got the Dow down by about 6% on a year-to-date basis, but up by 19% on a quarterly basis. The TSX down by about 5% as well on a year-to-date. A lot of damage, though, has been done underneath the surface, so stocks that you may own. And also, even though we've recouped a lot of the losses, again, we are still down quite significantly, particularly in the tech sector. The Nasdaq down by about 27%, again, on a year-to-date basis. So let's get some perspective in terms of where we stand and where we think we're going, not only into year-end, but of course into 2023. And for that, Martin Pelletier is joining us. He's a senior portfolio manager at Wellington-Atlus Private Counsel. Martin, great to have you with us and to provide perspective to our viewers with all of your background on the institutional as well as the retail side of Bay Street. So thanks for joining us.
Yeah, thanks for having me.
Martin, I do want to start off with your kind of big picture view. We did hear from the FOMC this week with respect to their minutes, and it does appear that the majority believe that they should slow the pace of tightening, but that the terminal rate might be higher than previously expected. I mean, the market took this as dovish, but this is key and critical in terms of where we want to invest going forward as it relates to the rates putting pressure on valuations and what areas of the market make the most sense. So what's your takeaway from what we heard, and what do you think they might really mean?
So it comes down to inflation and expectations and how central banks, in particular the Federal Reserve, is going to respond. Inflation is still quite high. Real rates are still negative. So we need to get to a positive territory. And so markets are going to, and market participants are continuing to try and figure out where inflation is going, especially on things like core CPI, which the Fed is keeping a very close eye on, and how the Fed is going to respond. We're used to living in a low rate QE environment, and participants are thinking, a lot of them in many cases are thinking we're going back to that scenario. And so when are we going to go back to that scenario? And that's where the bets are being placed.
And what do you think? Because there are many people who are indicating that we are absolutely seeing a slowdown in the economy, whether it's in the United States and or Canada. We're quite closely linked, obviously. And therefore, the Fed or the BOC will, in fact, really start to pull back. So in other words, we might actually be going back to that lower rate environment. But then there are others who will say, look, no, the economy is not that bad. And that we do need to combat inflation. And again, I talk a lot about interest rates with various guests, but it's so key and critical in terms of where we go next. And if there's going to be too much damage done, and has the Fed or the BOC gone too far, and will they cause a deeper recession? So what do you think will we ultimately see, let's say 6 months out from now?
Well, I don't think we're going to be in the depths of a recession or what many of the bear pundits are saying. And I mean, you can see that just by boots in the ground and by witnessing. Just go try and book a hotel this Christmas, and you're gonna spend $500 a night for a standard room at the Days Inn. Nothing against the Days Inn, but $500 a night's a little bit pushing it. So there's the services inflation that just isn't coming down. People are not canceling their holidays. Spending is still, even though savings are down and Visa bills are up. You're just not seeing the type of activity that you would witness during a typical recession. And so as long as this type of activity happens, I mean, look at Canada, retail sales were up 1.5% in October. And so you're still seeing that frontline behavior of spending by consumers. And that has to stop or slow down anyway before central banks start to consider slowing the pace of their hikes, which they already have a little bit. But when it comes to cutting it all together, we're still a ways away from that.
So do you liken, it seems as though you liken the current scenario to the time period of 2000, when we were seeing Greenspan raise rates, or the impact of that, and some negative pressure on stocks?
Yeah, and so we're looking at duration exposure. And duration exposure was very similar back to 2000 with technology companies and the sensitivity to interest rates. Maybe not to the same extent, but we're seeing that continue to play out in today's market environment.
We'll take a quick break. We'll be right back.